Okay, let's unpack this really interesting acquisition. We're doing a deep dive today into Eli Lilly buying Adverum Biotechnologies, ADVM.
Yeah, and it's definitely not your standard all-cash deal. This one, it's got layers, risk, maybe desperation, and this unusual thing called a contingent value, right? A CVR,
Which is basically what, like a derivative tied to future science outcomes?
pretty much. And the background here is key. ADVM was, well, they're really short on cash, facing serious liquidity issues.
Right.
So Lilly had to step in immediately, even before the deal closes, with a $65 million loan, just to keep the lights on, essentially.
Wow, so that distress, that really shapes the whole deal structure then.
Absolutely. It explains why the offer is split the way it is. You get the guaranteed cash part up front.
That's the $3.56 per share. Guaranteed money.
Exactly. And then you have this one CVR, which could pay out up to another 8.91 cents.
Making the total potential, if everything goes perfectly, $12.47 a share.
Correct. But look at the split that CVR, the contingent part, that's like 71% of the maximum value.
So it's heavily backloaded. Lilly puts down a relatively small amount of cash now.
And gives shareholders a shot at significant upside. But only, if the drug actually works out down the line. It bridges the valuation gap over the next decade.
Okay, let's talk about that drug then. What actually triggers that potential $8.91 payout? What needs to happen?
It all hangs on Ixo-vec. That's their main gene therapy candidate.
Right, the one for wet age-related macular degeneration, WAMD, the potential one-and-done treatment.
That's the one. So there are two specific milestones for the CVR payout. First, you get $1.78 in cash if Ixo-vec gets U.S. regulatory approval. That needs to happen within 7 years.
Okay, approval first. 7 years.
Then, the bigger chunk, $7.13 cash, that pays out if the drug hits annual worldwide net sales of over $1.0 billion. And that's within a 10-year window.
$1 billion in sales. That sounds like a massive hurdle.
It is. But you have to think about the current treatment for WAMD. Patients need injections, often monthly, right into their eye.
Ugh, yeah, not pleasant. A huge burden.
So if Ixo-vec really is a single-dose cure, or close to it, it could completely dominate that market. Suddenly $1 billion doesn't seem quite so crazy.
Okay, fair point. Now, you mentioned the CVR itself has an interesting feature.
Yes, this is where it gets particularly interesting for the market mechanics. Lilly specifically made the CVR non-transferable.
Non-transferable. Okay, why would they do that? Sounds like it just makes things complicated.
Well, it makes things simpler for Lilly. By making it non-tradable, they likely avoid having to register it as a security with the SEC. That saves them time. Regulatory hassle.
Yeah, I see. A regulatory shortcut for the acquirer.
Exactly. But it causes a major headache elsewhere, specifically for short sellers.
Right. How does that non-transferable status impact them? Why does it force them to act?
Because anyone short the stock, and that was about 7% of ADVM shares, they owe the merger consideration back to whoever they borrowed the shares from.
Which includes the cash and the CVR.
Precisely. But since this CVR isn't transferable, it can't be delivered through the usual clearing systems, like the DTC. There's no mechanism to hand it over.
So they physically can't deliver what they owe.
Correct. Their only option is to buy back the ADVM shares before the tender offer closes. They are forced to cover their short position.
Mandatory buying. And that explains the stock price. It's trading around $4.39 now, which is well above the $3.56 cash floor.
That's the squeeze in action. That inelastic demand from shorts pushes the price up.
Okay, so if we work backwards, $4.39 market price minus the $3.56 guaranteed cash. That means the market is valuing this CVR at only about, what, 33 cents?
Roughly, yeah.
Yeah.
$0.83 implied value compared to a maximum potential of $8.91. That's a huge discount.
Wow. So the market is clearly very skeptical about the CVR actually paying out. What's driving that skepticism?
Well, a few things. First, the clinical risk is real. Analysts are putting maybe a 60% chance on Ixo-vec even getting approved. That's far from certain.
Okay, 60% probability on the first hurdle.
Second, time. You're potentially locking up capital tied to this outcome for up to 10 years. Time value of money is a factor.
And third,
the illiquidity. This isn't like other CVRs you might be able to trade. Because it's non-transferable, once the deal closes, you're stuck with it. It's like a lottery ticket you can't sell.
locked in for a decade with no way out. That's a big risk to take.
A very big risk, especially for an asset tied to binary clinical outcomes.
Although we should mention there's maybe a slight positive on the timing. The phase 3 trial, Artemis, apparently enrollment is going faster than expected.
That's true. It could potentially pull forward the clinical data readout, maybe even to Q1 2027, which shaves off some time.
Still a few years away, though. So summing it up, what are the two profiles here for an ADVM shareholder right now?
You've got, on one hand, pretty high certainty on getting that $3.56 cash soon. That's backed by Lilly, a solid company, and boosted by this short covering dynamic.
And near-term cash seems safe.
But on the other hand, you have this highly speculative, completely illiquid bet on the long-term success of Ixo-vec wrapped up in that CVR.
So the final thought really comes down to commitment, doesn't it? Because the CVR is non-transferable, it forces a decision.
Absolutely. It forces you, if you hold through the deal close, to really ask, what financial risk, what clinical risk are you willing to lock up capital for, potentially for the next 10 years, with no exit?
That's the core question this deal structure puts right in front of every shareholder. A fascinating structure, really.